When a market collapses and headlines scream disaster, most traders believe the decline will never end. Then price stalls. It drifts sideways. Volume swells on breaks that go nowhere. Weeks later, the same asset that looked lifeless begins to rise with surprising ease. What changed? Not the news, control changed. Stock passed from weak hands to strong. Quiet absorption prepared the advance. When the road was cleared of supply, the markup unfolded naturally. And just as quietly, the next transfer would begin at the top. You sit in front of your screens and watch price surge without warning. A breakout explodes through resistance, social media erupts with excitement, and you feel the familiar pressure to act. Minutes later, the move stalls. The breakout fails. Price sinks back into the range and traps late buyers. Doubt creeps in. Was it manipulation? Was it random? Why does the market seem designed to punish urgency? Pause for a moment. Step back from the candle, by candle drama, and observe the broader structure. Markets do not move in disorder. They move in organized campaigns. What appears chaotic on the surface is often the visible footprint of large, well-capitalized interests building and unwinding positions over time. Before any meaningful advance begins, there is preparation. After a decline, price ceases to fall with the same ease. Volatility contracts. Downward pushes attract less follow-through. Volume expands on declines that fail to extend lower. This is not coincidence, it is absorption. Stronger hands quietly take the opposite side of emotional selling. They cannot buy everything at once. Doing so would drive price higher against themselves. Instead, they operate patiently within a range, testing supply, gauging participation, and gradually transferring ownership. When that transfer nears completion, something subtle changes. Downward reactions shorten. Attempts to push lower are met with firm demand. The range tightens. Then, when resistance is finally approached, price no longer hesitates. It moves with expanding spreads and decisive closes. The advance seems sudden to the public, but in truth, it was prepared long before the breakout candle appeared. The same logic governs major tops. After a prolonged rise, price no longer responds to bullish news with the same enthusiasm. Upward thrusts widen, yet progress diminishes. Volume increases, but results shrink. Late buyers driven by optimism provide liquidity. Meanwhile, stronger operators distribute inventory into that enthusiasm. The structure forms gradually, often disguised as consolidation or continuation. Only when demand is sufficiently weakened does price yield to gravity. In today's electronic markets, whether equities, futures, Forex, or crypto, the mechanics remain unchanged. Algorithms may execute orders faster, but they cannot bypass the necessity of building size. Large positions still require time. Liquidity must still be sourced. Supply must still be absorbed before markup. Demand must still be exhausted before decline. The professional trader's task is not to chase movement, but to recognize the campaign in progress. Is price in preparation, expansion, or transfer? Are wide spreads supported by volume and followed through, or contradicted by hesitation and lack of result? These questions shift your focus from noise to structure. Once you understand that markets rotate through organized phases rather than random bursts, clarity replaces confusion. Failed breakouts become tests, ranges become preparation zones, trends become the natural outcome of prior positioning. Instead of reacting emotionally to every surge or drop, you begin to operate in harmony with the dominant campaign. And when you align yourself with the side that has already prepared its move, the market no longer feels like a trap. It feels like a process you can read, anticipate, and trade with confidence. Price has been falling for weeks. Every rally is sold. News grows darker. Analysts downgrade targets. Your long position bleeds slowly, and eventually you surrender, convinced the asset is broken. Yet after your exit, something unsettling happens. The decline stops. Price begins to move sideways. It looks weak, lifeless, untradeable. Breaks below support quickly recover. Selling pressure no longer produces the same downward progress. You wonder, is this just a pause before another collapse? Do nothing for a moment. Instead of reacting to headlines or minor fluctuations, observe the character of the movement. A market that was once falling with urgency now hesitates. Spreads narrow. Volatility contracts. Downward pushes reach prior lows but fail to extend meaningfully. Volume expands on dips, yet the result is limited. These are not random signals. They suggest that supply is being met, absorbed, by stronger interests operating beneath the surface. After a prolonged decline, inventory rests largely in weak hands. Many holders bought at higher prices and endured losses. When price revisits lows, they are eager to exit at any opportunity. Their selling provides liquidity. Larger operators require that liquidity. They cannot accumulate significant size in one transaction without driving price sharply upward. Instead, they work within a defined range, purchasing gradually as discouraged participants release shares, contracts, or tokens. Within this range, specific behaviors appear repeatedly in modern markets. False breakdowns trigger stop-loss orders below support. Price briefly penetrates the level, activating market sell orders, then quickly returns inside the structure. That downward spike is not necessarily renewed weakness. It can be a deliberate test. If follow-through is absent and volume diminishes on subsequent declines, it suggests limited remaining supply. At the same time, upward attempts may stall near resistance. This is intentional. Premature advances attract breakout traders and momentum algorithms. If price rises too quickly, it invites supply before accumulation is complete. Therefore, the structure often feels frustrating, slow, repetitive, uneventful. This boredom serves a purpose. It discourages impatient traders and transfers ownership quietly. As the process matures, subtle strength emerges. Downward reactions become shorter in duration. Higher lows begin to form. Volume on rallies expands slightly, while volume on pullbacks contracts. These are signs that the available supply is diminishing. The path above is gradually clearing. When absorption is largely complete, the transition can appear sudden. A rally expands beyond resistance with decisive spreads and sustained follow-through. What looked stagnant transforms into initiative buying. But this movement is not spontaneous. It is the natural outcome of weeks or months of preparation. In today's environment, whether trading Nasdaq equities, crude oil futures, or digital assets, the principle remains identical. Institutions, funds, and well-capitalized participants must build positions over time. Liquidity clusters around obvious support. Stop-loss pools provide opportunity. The sideways structure becomes the workshop where positions are constructed. Recognizing this phase changes your behavior entirely. Instead of shorting every dip in a late-stage decline, you begin to evaluate the quality of selling. Instead of chasing premature breakouts, you study how price reacts to tests of the range boundaries. When you understand that this quiet transfer of ownership precedes meaningful advances, patience replaces frustration. The market is not lifeless, it is preparing. And when the preparation concludes, the advance that follows will often travel farther and faster than those who exited in discouragement ever expected. The breakout looks convincing. Price surges above resistance with wide spreads and rising volume. Financial media calls it the start of a new bull run. Social feeds fill with profit screenshots. You hesitate. You remember past breakouts that failed and reversed sharply. You've been trapped before, buying strength only to watch it collapse back into the range. Is this another illusion designed to pull in late participants? Slow down. Do not judge the move by one candle. Observe what follows. A genuine advance reveals itself not only in the breakout, but in how price behaves afterward. Does it hold above the former resistance? Do pullbacks retrace modestly and attract immediate demand? Does volume expand on upward pushes and contract on reactions? These details separate authentic strength from temporary enthusiasm. When a market completes its preparation phase, supply has largely been absorbed. There is little stock available from discouraged sellers. Under those conditions, even moderate buying interest can propel price higher with surprising ease. This is why advances after well-formed ranges often appear effortless. The road above has been cleared. In modern electronic markets, this dynamic unfolds quickly. Algorithms detect momentum, institutions deploy capital, and short sellers rush to cover as their stops are triggered above key levels. Those buy to cover orders add fuel. The movement accelerates not because of hype, but because opposing supply is scarce. Study the structure of the trend once it begins. A healthy advance forms a sequence of rising highs and rising lows. Each rally travels a meaningful distance. Each reaction respects prior support and retraces a smaller portion of the previous impulse. This tells you that demand is aggressive while supply is hesitant. Volume provides further confirmation. During upward impulses, participation increases. During pullbacks, activity declines. The market is communicating that sellers are less committed than buyers. If reactions grow deeper and volume expands on declines, that is an early warning. But as long as upward movements show strong result relative to effort, control remains on the buy side. Another key element is the character of consolidations within the trend. After a sharp rise, price may pause and move sideways. This is not automatically distribution. Often it is reaccumulation, a pause that refreshes the move. If the range forms on reduced volatility, with support holding firm and breakouts occurring with expanding volume, it suggests continuation rather than reversal. Many traders sabotage themselves during this phase. They take profits too early, fearful that gains will vanish. Or they attempt to short a strong market simply because it appears overextended. But strength is not defined by how far price has traveled. It is defined by the ongoing relationship between demand and supply. The professional approach is to align with the dominant force. Instead of predicting the top, monitor the evidence. As long as reactions remain controlled and upward pushes demonstrate initiative, the path of least resistance remains higher. When you understand the mechanics behind a genuine advance, hesitation gives way to clarity. You no longer chase blindly, nor do you fight the trend out of habit. You recognize that a well-prepared market can travel much farther than logic or headlines suggest. And by participating in harmony with that movement, managing risk beneath structural support, you allow the trend to work in your favor, rather than standing in its way. The breakout looks convincing. Price surges above resistance with wide spreads and rising volume. Financial media calls it the start of a new bull run. Social feeds fill with profit screenshots. You hesitate. You remember past breakouts that failed and reversed sharply. You've been trapped before, buying strength only to watch it collapse back into the range. Is this another illusion designed to pull in late participants? Slow down. Do not judge the move by one candle. Observe what follows. A genuine advance reveals itself not only in the breakout, but in how price behaves afterward. Does it hold above the former resistance? Do pullbacks retrace modestly and attract immediate demand? Does volume expand on upward pushes and contract on reactions? These details separate authentic strength from temporary enthusiasm. When a market completes its preparation phase, supply has largely been absorbed. There is little stock available from discouraged sellers. Under those conditions, even moderate buying interest can propel price higher with surprising ease. This is why advances after well-formed ranges often appear effortless. The road above has been cleared. In modern electronic markets, this dynamic unfolds quickly. Algorithms detect momentum, institutions deploy capital, and short sellers rush to cover as their stops are triggered above key levels. Those buy to cover orders add fuel. The movement accelerates not because of hype, but because opposing supply is scarce. Study the structure of the trend once it begins. A healthy advance forms a sequence of rising highs and rising lows. Each rally travels a meaningful distance. Each reaction respects prior support and retraces a smaller portion of the previous impulse. This tells you that demand is aggressive while supply is hesitant. Volume provides further confirmation. During upward impulses, participation increases. During pullbacks, activity declines. The market is communicating that sellers are less committed than buyers. If reactions grow deeper and volume expands on declines, that is an early warning. But as long as upward movements show strong result relative to effort, control remains on the buy side. Another key element is the character of consolidations within the trend. After a sharp rise, price may pause and move sideways. This is not automatically distribution. Often it is reaccumulation, a pause that refreshes the move. If the range forms on reduced volatility, with support holding firm and breakouts occurring with expanding volume, it suggests continuation rather than reversal. Many traders sabotage themselves during this phase. They take profits too early, fearful that gains will vanish. Or they attempt to short a strong market simply because it appears overextended. But strength is not defined by how far price has traveled. It is defined by the ongoing relationship between demand and supply. The professional approach is to align with the dominant force. Instead of predicting the top, monitor the evidence. As long as reactions remain controlled and upward pushes demonstrate initiative, the path of least resistance remains higher. When you understand the mechanics behind a genuine advance, hesitation gives way to clarity. You no longer chase blindly, nor do you fight the trend out of habit. You recognize that a well-prepared market can travel much farther than logic or headlines suggest, and by participating in harmony with that movement, managing risk beneath structural support, you allow the trend to work in your favor rather than standing in its way. Price has been rising for months. Every dip has been rewarded. Breakouts continue to print new highs. Analysts revise targets upward. Social platforms celebrate the inevitable continuation, yet something begins to feel different. Rallies stretch higher, but progress seems harder. Wide candles appear, followed by sudden reversals. Volume expands, but the chart no longer advances with the same ease. You sense strength, yet the market no longer behaves as it once did. Is this just consolidation before another surge? Pause and observe more carefully. At mature highs, the character of price subtly changes. After a sustained advance, inventory gradually shifts from strong ownership to less informed participants. Late buyers, driven by optimism and performance chasing, become increasingly active. Their market orders provide liquidity. Larger operators who accumulated at lower levels require that liquidity to exit substantial positions without collapsing price against themselves. This transfer does not occur in a single session. It develops within a range. Volatility often increases. Upward thrusts break prior highs, attracting breakout traders and triggering stop orders from short sellers. But these breakouts frequently struggle to follow through. Price may quickly re-enter the range, leaving long upper wicks or failed expansions. Each attempt higher meets supply that was not present earlier in the trend. Volume offers further insight. Large activity appears near the top of the structure, yet the result becomes limited. Wide spreads occur without sustained continuation. This imbalance between effort and outcome signals that supply is absorbing demand. Buyers are active, but they are meeting equal or greater selling pressure. In modern markets, this phase can be intensified by derivatives positioning and leveraged speculation. Funding rates in crypto turn extreme. Call option activity surges in equities. Retail participation spikes. These conditions create the perfect environment for distribution, not because the asset is bad, but because enthusiasm provides the necessary counterpart for large-scale selling. Within the range, certain events stand out. A sharp rally may pierce resistance decisively, only to reverse sharply. That upward surge often triggers buy stops clustered above obvious highs. Once filled, price retreats as aggressive demand dries up. On the downside, reactions may reach support, but fail to break decisively, at least initially. This keeps confidence intact while the transfer continues. As the structure matures, rallies grow shorter in distance, lower highs begin to form. Support levels are tested more frequently. When support finally gives way with expanding spreads and strong participation, it reveals that demand has weakened substantially. The path below begins to clear. Many traders misinterpret this phase. They assume high volatility equals opportunity for continuation. They buy each breakout aggressively, unaware that they are providing liquidity to stronger hands exiting positions. The chart may still look bullish at first glance, but its internal quality has deteriorated. Understanding this process shifts your approach entirely. Instead of chasing strength blindly, you evaluate the relationship between volume and result. Instead of assuming every consolidation is continuation, you ask whether supply is quietly dominating. When you recognize the signs of distribution, you avoid becoming the final buyer at elevated prices. You protect profits earned during the advance. And when the eventual decline begins, you are not surprised, you are prepared. The market did not suddenly turn. It simply completed a transfer that had been developing for weeks. By reading that transfer correctly, you move from being part of the crowd to operating with structure and clarity. Support breaks. The level that held for weeks gives way in a single wide candle. Stops cascade. News turns negative overnight. Social feeds fill with panic. You watch price slice through prior lows as if they never existed. Every small bounce is sold aggressively. The chart feels heavy, unstable, dangerous. You consider buying the dip. After all, it has worked so many times before, but something is different. The rebounds lack conviction. They stall quickly. The market no longer rewards optimism. Step back and examine the structure. When a distribution phase completes, demand has already been weakened. Inventory has shifted. Strong hands have largely exited. What remains is ownership concentrated in late buyers, participants who entered near the highs, often with leverage and little tolerance for drawdown. When price breaks beneath established support, their protective stops activate. Those market sell orders intensify downward pressure. In modern electronic markets, this acceleration can be swift. Algorithmic systems detect the breakdown and initiate short exposure. Leveraged traders face margin calls. Liquidations in futures and crypto amplify selling. What appears as sudden collapse is often the natural continuation of a process that began at the top of the range. Observe the character of rallies during this phase. They are sharp but brief. A short squeeze or profit taking bounce may produce a fast upward spike, yet volume on these rebounds frequently contracts relative to the prior decline. Price struggles to reclaim broken support. Former support now acts as resistance. Each rally that fails slightly lower than the previous one forms a sequence of declining highs. Volume behavior offers additional clarity. Downward impulses often expand with strong participation. Reactions upward show weaker engagement. This imbalance reflects aggressive supply meeting hesitant demand. Sellers are willing, buyers are cautious. The path of least resistance tilts downward. There are also moments of apparent stabilization. Price may move sideways after a steep drop. Traders interpret this as base building. Yet the key question is who is in control. If rallies within that range lack expansion and downside probes attract continued supply, the pause is often redistribution, a brief refresh before continuation lower. Many traders struggle in this environment because they rely on past behavior. They assume every decline will be followed by immediate recovery. But once control shifts, the market operates under different conditions. Dip, buying without evidence of absorption becomes costly. Professional analysis during this phase focuses on quality, not emotion. Does price break support with ease? Are pullbacks shallow and short-lived? Is volume supportive of downward movement? Are lower lows and lower highs developing consistently? These observations remove guesswork. Eventually, The decline will approach a level attractive to larger interests. Selling pressure will begin to show diminishing result relative to effort. Volatility may compress. But until those signs appear, the dominant force remains supply. Understanding this stage transforms your response. Instead of fighting the trend or hoping for immediate recovery, you align with structure. You protect capital. You evaluate short opportunities in harmony with prevailing momentum. And when the decline finally exhausts itself and a new base begins to form, you will recognize it not by prediction, but by the evidence left in price and volume. The breakdown was not random. It was the logical outcome of prior distribution. By reading it correctly, you trade with awareness rather than reaction. You open your charts and feel conflicted. The daily trend is rising strongly. Headlines are optimistic. Yet on the 1-hour chart, price is breaking support. On the weekly chart, price is pressing into a major resistance zone formed years ago. Which direction is correct? You buy because the larger trend is up, then intraday weakness stops you out. You short because the lower time frame looks heavy, then the higher trend resumes and squeezes you. It feels inconsistent, almost deceptive. Pause and widen your lens. Markets do not operate on a single time frame. The complete price cycle, preparation, advance, transfer, decline, unfolds simultaneously across multiple degrees. What appears as strength on one chart may be late-stage behavior on another. Without context, every move feels contradictory. With context, the puzzle begins to align. Consider this: a weekly chart may show price emerging from a long accumulation range. The broader campaign suggests higher objectives over months. Meanwhile, on the daily chart, price may be consolidating after a sharp markup phase. On the intraday chart, that consolidation might resemble distribution before a short-term drop. All three observations can be true at once. The key lies in identifying which cycle you are trading. If you operate intraday, your focus must remain on the structure within that time frame. A short-term redistribution range can produce a meaningful decline, even if the higher time frame remains bullish. Conversely, if you are building swing positions aligned with weekly accumulation, minor daily pullbacks are often opportunities rather than threats. Modern markets amplify this multi-layered behavior. High-frequency algorithms exploit micro-imbalances within minutes. Swing funds operate across days and weeks. Long-term institutions position across quarters and years. Each participant influences price according to their horizon. The chart reflects this interaction as nested cycles, smaller rotations inside larger ones. Observe how this plays out in practice. A strong weekly advance pauses and forms a trading range. On the daily chart, that range may reveal reaccumulation if pullbacks are shallow and volume contracts on declines. On the 4-hour chart, false breakdowns may occur to shake out weak holders before continuation. Traders who fail to recognize the higher structure often misinterpret these events as full reversals. The reverse also applies. A weekly chart may show distribution forming near major historical resistance. The daily chart continues to trend upward, printing marginal new highs. On lower time frames, sharp rallies appear convincing. But if volume expands on limited progress and reactions deepen gradually, it signals that the broader transfer is underway. Those trading blindly with the short-term momentum risk aligning against the dominant campaign. Clarity comes from alignment. Begin with the higher time frame to determine where price stands within its larger cycle. Is it emerging from preparation, advancing freely, pausing for continuation, or showing signs of exhaustion? Then refine your execution on the lower time frame, ensuring your entries harmonize with that broader condition. When you understand that cycles rotate across all degrees simultaneously, confusion subsides. Conflicting signals transform into layered information. Instead of reacting emotionally to every fluctuation, you recognize each move as part of a larger structure, and once you align your strategy with the appropriate time frame, trading in harmony with the dominant cycle rather than fighting it, the market no longer feels inconsistent. It feels organized, deliberate, and far more navigable. Markets are not random waves of chaos. They move through organized campaigns, quiet preparation, decisive advance, strategic transfer, and inevitable decline, repeating across time frames and asset classes. What appears sudden is usually prepared long in advance. What feels shocking is often the final stage of a process already visible to the trained eye. When you study price and volume together, you begin to see these rotations clearly. Ranges are no longer boring pauses, they are zones of positioning. Trends are not accidents, they are the result of prior absorption or distribution. Breakdowns and breakouts are not surprises, they are confirmations that ownership has shifted. The professional trader's edge lies in recognizing where the market stands within this complete cycle. Instead of chasing headlines, you evaluate effort versus result. Instead of predicting tops and bottoms, you observe the behavior of supply and demand. Instead of reacting emotionally, you align with structure. Every phase serves a purpose. Accumulation prepares the advance. The advance attracts participation. Distribution transfers inventory. Decline resets value and begins the process anew. These rotations occur in equities, futures, Forex, and crypto alike, unchanged by technology, unchanged by speed. Master the cycle, and you stop fighting the market's movement. You begin operating in harmony with it, and when you trade in alignment with the dominant phase, consistency replaces confusion, discipline replaces impulse, and the market becomes less of a mystery and far more of a structured opportunity.